Matt mentioned, and a couple of things really stand out. First and foremost, really well attended, so well done to Marine Money guys. It's really impressive to see so many senior leaders from the industry attending the conference, which is great. And then it's my first conference here, but I do attend a lot of broader transportation conferences around the world, and I feel like this one should get an award for the best location, so really well done there as well. So I will quickly introduce myself. I'm a managing director in our transportation business. I focus on structured debt and equity, as well as credit finance. And Goldman in general has transportation bankers all around the world that focus on coverage across various subsectors. So it can be aviation, it can be container, rail, trucking, amongst others. And a number of the themes that I was going to mention are going to be in line with what the previous panel has already mentioned in terms of the importance of capital markets and some of the struggles that you may have with capital markets, such as the high yield market right now. But one of the areas, one of the subsectors or smaller segments of the capital markets where I personally see from my lens other transportation asset classes being very active in structured private placement market. It could be aviation, it could be, again, containers and rail, versus I don't see shipping and the ship owners tapping that market as often, is the structured private placement market, which is where, if you can go to the next slide, I'm not sure who's handling. Thank you. So we structured a transaction for Global Ship Lease. Really fortunate to have the opportunity to work with them. But the philosophy behind structured market is various different companies that are rated or unrated through some technology, through some structuring, through some cash flow, can issue notes and bonds significantly above their corporate rating. Or again, if they are unrated, then they can get into investment grade ratings. And I'm not sure how familiar this audience is with structured product market, but you can get up to 9 notches of ratings uplift. Said differently, a single B rated company can issue single A rated bonds, and that happens quite frequently amongst the other transportation asset classes that I mentioned. Again, for context, those transportation asset classes use this market for up to 10, maybe $15 billion issuance size per year. Versus as far as shipping is concerned, again, the market is not as widely used, which is where this Global Ship Lease transaction we thought was quite unique and really cool the way it was done. So the left-hand side of the page clearly lays out the terms. I think they are self-explanatory. I will just talk about some of the pillars of this transaction, maybe 4 themes that I will highlight. First and foremost, the collateral, it is summarized at the bottom right side of the page. It was older vessels, container ships that were put together in the form of a quasi-securitization. And the charters that they had, the cash flows that they generated were levered up. So collateral, I think, the way to think about it in my mind for this kind of market, for this kind of buyer base is any collateral can work so long as it is structured appropriately and it is managed appropriately. So obviously, if you have brand new vessels and longer charters, it is straightforward. But that doesn't mean that if you have older vessels or shorter charters, nothing can be done. Clearly, the transaction demonstrated that you can structure and you can find a lot of demand for it. So collateral is your first pillar. Your second pillar is the structure. How much leverage are you raising? Are you raising too much leverage? You have to amortize faster. Are you raising less leverage, in which case you can have more dividends coming out of the structure, lower debt service. But finding the appropriate structure, appropriate amount of leverage that you're raising for a given transaction, amortizing it appropriately would be the second pillar of the transaction. And you have to find the right balance between leverage raised and how do the notes amortize. And then the third pillar would be covenants. Ultimately, the buyer base for this market is insurance accounts based out of the US that buy rated paper. I'm sure a number of you all sitting here will be familiar with some of those buyers because it includes the likes of PIMCOs and AIGs with billions and billions of dollars of assets under management, very sophisticated investors. When they are coming in the space, obviously, they are going to require the right set of covenants and downside protections. So across both your corporate financial covenants as well as asset-based covenants. But once you bring those three pillars together, the fourth one that would be most important would be having best-in-class sponsor, best-in-class asset manager, and the owner of the vessels that can monetize these assets, remarket these assets in the right way at the right time when charters expire. And Global Ship Lease brand was really well received in the market in that regard. So in our view, given this is one of the first ones of its kind that is done, it's a transaction that really stands out in shipping space. We think there could be so many more, and so many of you all sitting here as ship owners that can tap into this technology and this product, because frankly, a number of your peers in other asset classes use these kinds of products and these kinds of market very, very often. As I mentioned earlier, $10 to $15 billion volume per year individually in, say, an aviation or a rail and container type of asset classes. The last thing that I would mention on this particular transaction is that if you're using this very particular technology, and you don't always have to, because there can be many different tools in the overall toolkit when it comes to structured product market, but this one in particular works off of your corporate rating. GSL obviously is a rated entity. It works off of your corporate rating, and for the collateral and the structure and the manager, the pillars that we spoke about, you get notched up from where your corporate is, and the notching can be quite significant. But a number of privately held companies within different transportation sectors are not rated. But they have collateral, they have diversification, they have long streams of cash flow. So even those structures can find demand in this market. And that's what we have tried to explain on this other slide. And the slide may have a lot of content, and it may seem a little bit complicated, but this is the bread and butter of securitization market. The volumes that I mentioned earlier is true of esoteric asset classes, but in general, mortgages, CLOs, they are hundreds of billions of dollars in size, very deep pockets when it comes to securitization, of which I haven't seen shipping owners use it as frequently, but as I mentioned, many others do. And the philosophy here is to come up with bankruptcy remote structures, so having your vessels held separately outside of the balance sheet within a box, which is domiciled in a tax-friendly, investor-friendly jurisdiction. The box that is owning these vessels will have some diversification. So it can be diversification in the form of different types of vessels. It can be diversification in the form of different types of charter counterparties. But it has to be some sort of diversification, given this isn't a balance sheet, this isn't a corporate entity. It is an entity with static pool of assets that will slowly amortize down over time and go away. And this entity should be capable of paying off debt and its equity holders through the assets that are transferred one time. It is then completely externally managed, as laid out at the bottom right of this page. So the owner will be the servicer and manager for these kinds of vehicles. There'll be some external trustees and whatnot, which typically you see in any form of financing that will manage the vehicle. But these kind of structures across all the different transportation asset classes, as well as several other markets, be it whole business and whatnot, get to single A, triple B rating. Some of the industries that have better fundamentals get to AA and AAA ratings as well. And accordingly, the price that they realize is significantly tighter than what you would see in, say, a high-yield market, or sometimes even in direct investment-grade market. So it's some of the learnings that I wanted to just present as an idea from what we see in several other asset classes, maybe a bit less so in shipping, but with number of themes that the prior panel mentioned on how this industry is coming out as being counter-cyclical. There's no doubt that there is volatility, and there will remain volatility. The asset prices will go up and down. But a number of those concerns can be mitigated through the right kind of structuring. And we do think, based on the first transaction that we did for GSL, that there can be significant demand in this market, which a number of participants can benefit from. The last thing I would say is, It is a fixed rate market, which I think is great because these are fixed rate assets generally. They have leases, they produce fixed rate rent, and there isn't a perfect hedge as such. We heard about it in one of the panels in the morning. So if your fixed rate assets match with fixed rate liability, that can be really great. And this market, by and large, almost 100% is on a fixed rate basis. So the transaction that we priced a few months ago for GSL was about 5.6, 5.7%, and that is fixed for the life. So hopefully some of this, all of you all may have found interesting. If there are any questions, we can talk about it offline, but that would be it from my side.
Kailesh, thank you very much. Good to have you with us.